Hello guys, the objective of this video is to show you the key concepts in a smart money trading style. So we are going to see what smart money entails, and then we are also going to see the key concepts that are in smart money trading style. So basically, smart money concepts or just smart money in general is just a trading strategy and a market analysis approach that focuses on understanding and identifying the actions and behaviors of institutional investors, or the so-called smart money. So these smart monies or these big financial institutions are mostly hedge funds, big banks like the Citibank, etc., Bank of America, and other financial institutions. So they are the ones we refer to them as the smart money or just smart, because they have access to more information, better research, greater resources than retail traders. So generally SMCs aims to track and follow the footprints of these institutional players to participate in the market moves and make informed decisions. So they are the big boys who move the market, or they are normally called the market movers. So how do you know that there was trail of the market movers? That boils down to what is called the key concepts in smart money. So let's begin by looking at the key concept of smart money. The first one that we are going to look at right now is called market structure. Now, a market structure is a wide concept in smart money, or generally SMC, and it is also there in demand and supply trading. It is also there in support and resistance, etc. So basically market structure is divided into two sections: the major structures, the minor structures, and then generally how the market moves is simply on range, initiation, mitigation, and then continuation. So as you can see, this example I've drawn here is an example of a bullish trend whereby the market is moving aggressively to the upward, and then retraces, then moves again, retraces, moves in that order, and then the opposite is a downtrend. As you can see in this illustration, the market moves downwards aggressively and then it pulls back, moves aggressively, pulls back. So these pullbacks and the movement are what are generally referred to as market structure. Now ideally the real market does not move like this, it moves like this. So this is explained by a type of market structure, we call it RIMC, or it generally means range. The market always begins with the range to induce more people to buy and start confusing people, so that more buyers and sellers can step into the market, especially the retail ones. And then it initiated a move to one direction after possibly manipulating people, and then it mitigates the order, and then it continues that way. So this is the circle under which the market moves. This is an example here whereby a market moves and then it starts ranging, as you can see here, and then it initiates either upwards or downwards, and then it comes back to mitigate the orders that are already not been fulfilled, and then again it continues. So this initiation phase and continuation phase are always very rapid, and sometimes even the mitigation are very rapid. It starts to forms it shows some form of V shape to know that the market is about to mitigate the remaining order, and then moves, and then after it breaks structure, the weaker structure, it again ranges and then moves upwards, and then if it changes strength, like you can see in this. So this is the ideal market condition, but this is hypothetical, the one that people use to show you generally how the market moves. But this is how, if you open any chart, you will see something like this, very much confusing, and that is how the market moves. So the first concept in smart money that you need to know is market structure. And I've said it's made up of two types, major and minor. Within this major structure there are minor pullbacks and other breaks of structures within here. Same to this major movement, there is minor structure within it that looks like this, but in a choppy manner. Now the next smart money concept that you need to know maybe as a beginner is what is called liquidity. So basically when you're starting, liquidity becomes really complicated and a little bit confusing, but in simple terms, the term liquidity only refers to money. Generally it is areas where players enter or leave the market. So if somebody asks you what is liquidity, you just respond by saying money, where the money is in the market, where the big boys are stacking money, retailers are putting their orders, and anywhere that money is being interacted in the market, that is what is referred to liquidity. Or the generic definition is liquidity is a crucial concept in SMC that entails the ease with which assets or prices can be bought or sold without significantly affecting their prices. Institutional investors require high liquidity to enter or exit positions, and SMC traders often look for this particular liquidity pools, area where concentration of buyers or sellers orders are, to predict where the institutional traders might be active and intends to move the market. So where exactly should you be looking liquidity to find liquidity rather? The areas include number one is entry prices, where people enter their orders, where people exit their orders, where stop losses are, and where take profits are. Those areas you will see reaction taking place, either the market reversing or the market expand from that particular point. We call it displacement in SMC. Now examples of liquidity points are trend lines. If you place a trend line like this, anywhere that the market is touching the trend, it means people are stacking more orders. Then at some point the market will reverse aggressively to take all their stop losses and then move again in another direction. So trend line is number one area of liquidity that you need to pay more attention to. Now the next liquidity point is all sessions highs and lows, especially the Asian session is what people mostly refer to as the liquidity point, because in most occasions the market will always manipulate either the highs or the lows of Asian session and then aggressively move away from it. So it plays what I was telling you in the other point of RIMC, whereby we have a range and then we have an like a manipulation sort of, then we have range, initiation, mitigation, and then continuation. So major session high either should be London, most so London and Asia. That is where we have a lot of liquidity pools within their highs and lows. So in most occasions you will see the market, I'm going to show you with more examples, where the market pinches or kisses the highs and the lows, and then immediately it reverses while displacing. Another liquidity point that you need to take note is the take profits of areas. So areas where people most likely take profit, or the big boys take profit, you will see the market reversing immediately, meaning that it is now pulling back to seek for more orders or to find better price entries. At the same time, where stop losses are, you will find that price will always be pulling towards it and then immediately reverse in the opposite direction. Again, where people enter trades is also another point, especially for the big financial institutions. You will find out that the market will always come closer to that particular area and then exponentially move very fast. So those ones are area points, and that is liquidity concept simplified. Now the third area of SMC is what is called order blocks. Now an order block is basically an area whereby there is some gap in it. We call it fair value gap, and then it is the last candle, it is the last price candle of any time frame just before the expulsion or the big moves. So in smart money we are assuming that the big boys came into play at that particular point, and therefore the market moved significantly, as you can see in this example. So we wait for the market to pull back, and you can see when it pulls choppily like this, it means that these are small institutions. But now upon tapping the order block, the last candle before the opposite move, immediately it touches that order block, you can see another aggressive move away from it, and then it causes another maybe sort of break of structure, or just a pullback to it again, another order block. This is another order block, the last candle before the opposite expulsive move. You can see there's a tap on it, and then the market reverses again, and then there's another break here. The last candle, you check on the last candle with the imbalance, you can see that market tapped on it, never broke above it, and then it moves again in the opposite direction. So basically order block operates in the basis of supply and demand, whereby the market moves and then taps on the supply in this case, and then it pushes downwards, like in this example. So the opposite is also true. You can check in your chart, you will find the opposite looking like this also, whereby market retraces back to the demand and then it pushes upward. So order blocks are also another important concept. So generally order blocks are specific price areas where institutional buying or selling orders have been placed. These are zones of high interest where significant transactions have occurred, creating support or resistance level. Identifying order blocks will help you as a trader. If you can identify the accurate order block, it will help you as a trader to understand potential reversal points or areas of price consolidation. So as you can see, tapped here, reverse, tapped here, again reverse, tapped here, reverse, and then until the order block was exhausted, because now more big players stepped in the opposite direction. So these points become liquidity points, as I showed. These areas becomes liquidity points. As you can see, anytime it was touching around the trend line, it was taking more orders, means stop losses were over here, stop losses were over here, and that is why the market expulsively move in the opposite direction to tap on those particular stop losses. Now this is an example of this is an indicator showing Asia, London and New York. If you can see here, the market raided the highs of Asia. This is Asian session, and immediately it reversed backwards and then started loading more order. Again, when New York opened raided the lows of London session and immediately took the opposite direction. So that is mostly how liquidity points work. Now another smart money concept is called fair value gap. Now fair value gap have other names. We also call it imbalance, we also call it inefficiencies and gaps. Now fair value gaps are just imbalances or voids in the price action that occur when there is sudden surge of buying or selling. We call it displacement behind unfulfilled orders. So as an SMC trader, you use this gap to identify where the big player stepped in the market. So you wait for a pullback to it, and then you can enter from that particular point, because we are assuming that the displacement are taking place because the big players are stepping in the market. So it gives a potential point when market pulls back. Now let me show you an example. If you look at here, so how do you identify an order block in the simplest manner? You check 3 candles. It must be 3 candles following each other like this. So imbalance is that space or void that is in between the last candle wick, that is the last candle's wick and the the first candle's wick and the last candle's wick. You check here the closing of this candle and the opening of this candle. So this imbalance here or space is what we are referring to as what we are referring to as imbalance. That space between the close of the first candle and the open of the third candle, that is what we are referring to as fair value gap, imbalance, or inefficiency in the market. It shows that the big players have stepped in the market and therefore they are ready to move the market, and that is why you are seeing it being displaced. It means there are no order. Ideally, there is in the order book there are no orders in that particular point, and that is why the market rushed to pick the orders that were below it, leaving that balance. So the market is always efficient, and therefore it will want to pull back again to come and fulfill and fill that void. As you can see, this was the first candle and this is the third candle. So this space here is what we are referring to as imbalance or fair value gap, the space between the first candle and the third candle. So that space that is engulfing the second candle is what we are calling fair value gap. You can see as this example, this is the space in between this candle, then there's this second candle, and then there's this third candle. So the wick here and the wick here, this space is what is called fair value gap. You can see price tapped on it here, and with the help of the order block that was here, they got mitigated, and that is how the price reversed from this particular point. So SMC traders combine both order block and fair value gap to identify possible entry points. You can see these two, there was imbalance there and there was an order block. An order block without an imbalance is called a mitigated order block, and therefore it should be avoided because it had already done its purpose, and for that reason we don't reuse order block in SMCs. We don't reuse fair value gaps in a SMC. Once mitigated, its purpose is done. You can see there's another example over here. This is the third candle, but it engulfed this, so we don't count this other one. So we check at this candle's high low here and this candle's high. This space here from this point to this point is what we are referring to as imbalance. You can even proceed and check in that particular ascending pattern. You can see here there's this third candle, there's this first candle, second, third. The space between this wick, this third candle wick, and the other first wick is what is we refer to as fair value gap or generally imbalance. There's another space here, so just go to your chart and check the spaces between the first and the third candle. That candle within the middle will give you fair value gap. There's another one here for the buy direction. Price tapped on it and then move. So sometimes the price will not tap on the order block, it will tap on the fair value gaps and then move. So you pick it. Most SMC traders that are not ICT traders operate with order block, but ICT traders operate with a fair value gap. So if you are watching this video past 1 month, I shall have made the difference between SMC traders and ICT traders, so you will find more there. Another concept of SMC is called accumulation, manipulation, distribution, or AMD circle in general. So how does it work? AMD circle tries to trace how the market moves, like the one I was showing you of range, initiation, mitigation, continuation. So what does it? These are the phases in the market cycle where smart money accumulates or distributes large positions. Accumulation usually occurs in a sideways market after a significant downtrend or uptrend. So SMC traders, we look for these phases to align our trading direction. As you can see in this uptrend example here I've drawn, the market moves upwards aggressively. We call it rally for for supply and demand traders, they call it rally, and then a base or initiation range. So once we have initiated, we will always, or this was continuation of some range here. So this was continuation, and then we start again with range, and then we have manipulation here taking place, this M here. So this is accumulation, we can also call it range, and then we have manipulation here, and then it shows people that want to move downward, and then it moves in the opposite direction. So that move in the opposite direction is what is called distribution. So your goal is to always look for ranges, and from the ranges try and spot where the market moves aggressively in that opposite direction. But if you see it moving on a slight momentum, just know that that is possible manipulation point, so you give market more time to breathe. This is a downtrend example whereby the market is accumulating orders in this particular box I've shown, and then it manipulates people that it wants to move upwards, and then it moves downward. That downward displacement, that downward move, we call it displacement or distribution or continuation or initiation. So in SMC we usually call it distribution or displacement. Now there is another concept called break of structure. Now this is a very important one because it relates with the other part, which was market structure. So as you can see, I showed the market structure whereby market is moving up and down in uptrend, and then it starts to move downwards, pulls back downwards, pulls back downwards, pulls back, in that order. So how do you identify break of structure? Break of structure is when a market pulls back. It must be 50%, otherwise that is called a range, and then initiates upward. So when it initiates upward, breaking the previous high or low, we call it break of structure. As you can see, there was a break of structure here, there was a pullback, break of structure, initiation, pullback, break of structure, initiation, and then we have a pullback, break of structure. So the last break of structure before the market turns its course, I usually refer to it as liquidity points, because there are people who were early sellers here that got manipulated, and then the market came back. So you can call it break of structure or you can call it liquidity, but I most likely see it as liquidity because it is the last point that the market reaches before reversing. So that reversal, that break of the previous high or low in a market, is what is called change of character. We also call it market structure shift. Now the ICT people tend to call it market structure shift. The common SMC traders call it change of character. They all mean the same thing, the point at which the market is reversing. So be keen on that, and then the market now start to move in a downtrend whereby there's a pullback. It must be 50% for it to be categorized as pullback, or it will be considered an inducement point or just a range. So like this, we have a pullback, a push, we break structure, pullback, push, we break structure, pullback, push, we break structure, in that order until the market is able to reach a point of interest. It can be order block, it can be fair value gap in a higher time frame, etc. It can be supply and demand, etc. So it will start now reversing again, leaving more liquidity on the trend line it had created. In most occasions, you will see that the market creates three touch points in a trend line: first, second, and then it breaks in the opposite direction. First, second, third, breaks in the opposite direction. So like in this case, there was a liquidity point here raided, and then market immediately reversed. So I don't call it break of structure here, I call it liquidity trade, because I only confirm this liquidity trade when I see this change in character or market structure shift, and then the rest becomes a break of structure. Now take keen note that this break of structure here can also be called change of character. If you're watching this thing past 1 week, I shall have created different change of characters, so you can know which one is now your preferred way of calling it. This second one can also be called change of character or break of structure, but mostly I like calling it break of structure because it is the only thing that confirms that the market is now in the opposite direction. It is no longer in that particular direction that initially it was moving. Like in this case, this confirms that now we are having a uptrend. So we have a pullback, break of structure, pullback, break of structure, and then we have a small pullback, and then we have a touch in point of interest, and then we have a deeper pullback. This deeper pullback causes what is called market structure shift, or the change in character. Now basically BOS or break of structures refers to a significant change in the market structure indicating a potential trend, reversal, or continuation point. Change of character is more refined concept that focuses on subtle changes in the market behavior that might precede a break of structure, allowing traders to anticipate a bigger move in the opposite direction. Now there are other concepts that you can check on your own, or just check here in this particular channel. If you're watching this thing past 1 month, I shall have made past 1 week, I shall have made all these videos covering the following concept, so you can learn more about what is called breaker blocks or BB breaker blocks. There are inducements, there are inverse fair value gaps, Wyckoff schematics, stop hands, displacement, mitigation blocks, mitigated and unmitigated order block or fair value gaps. We have single candle order blocks, we call it SCOBs. Then we have supply and demand POI or zones, and then we have point of interest, different points of interest, and which one is legitimate. We can even add here another concept called valid pullbacks. You have to know valid pullbacks, otherwise we just don't count candles and say that was a valid pullback. So you must just check in this channel. You will find all these concepts specifically explained in their individual videos. Otherwise, if you're still new, apply smart money concepts and combine them with other technical analysis tools such as support and resistance if you can, trend lines like I've shown, Fibonacci retracement levels, and candlestick patterns. All these things are here in the channel. You can just check, you will find them explained. So when you understand these actions and intentions of these big boys, you can align these strategies to benefit from the movement driven by the smart money or the big boys. So as an SMC trader, you are required to have an extremely deep understanding of the market dynamics, patient discipline to wait for high probability setups. So you also need to be continuously learning and adapting to the institutional strategies, because if you check on YouTube, you will find videos showing how smart money concept are no longer working, just like support and resistance, etc. So just be versatile and find how to use these smart money concepts well.